Hello everyone, this is Crystal with Slick Trade, and in this presentation I'm going to cover the pure price action presentation number 8. Today we're going to talk about bullish and bearish rectangle patterns. As always, before we get started, we must start with a disclaimer. When trading any financial asset, there's a possibility that you may sustain a partial or total loss of your investment funds. As a result, it is advised you should never invest with or trade upon money which you cannot afford to lose through this manner of trading. Trading involves a real risk of loss, and past performance does not ensure future results. Please feel free to pause this video to read through the entire disclaimer. Bullish and bearish rectangle patterns. These patterns produce an approximate 78% win rate. They are considered continuation of price patterns. The rectangle pattern is defined by a strong trending move followed by two or more nearly equal tops and bottoms where price stays within two parallel trend lines that are horizontal. The bullish rectangle pattern begins after a bullish trending move and is considered successful when price extends beyond the breakout point by the same distance as the width of the parallel lines. In the example to the right, we see a bullish rectangle pattern. As you can see, we started, there was a bullish trending move right here. Here, we had price, these are your two parallel lines, okay, that I'm talking about, horizontal parallel lines, and price stayed within these. A lot of the time, for rectangle patterns, you'll notice that it looks almost like a double or triple top or bottom, okay, it almost has that appearance to it. But then it continues, okay, that's the continuation of price. It breaks that previous high, and it continues in its uptrend, okay? Now this one is considered successful because price did move more than, well, equal to or more than, in this scenario it did move more than the number of pips that were within this, these parallel lines here, okay? So, bullish rectangle pattern, you're looking for a previous bullish trend, you're thinking, oh hey, it might be time for reversal, and look at that, it came right down to previous support and broke the resistance line here. That's where you'd enter your long. The bearish rectangle pattern begins after a bearish trending move and is considered successful when price extends beyond the breakout point by the same distance as the width of the parallel lines. So you can see in the example to the right, we have a bearish trend. Okay, looks almost like a double bottom. Actually, it looks kind of like a triple bottom right here. See how it hit 1, 2, and 3 times at this support level. Okay, then, boom, price break right here. Breaks that support, continues in its downward trend, okay? So, this one was considered successful because it moved the same distance as the parallel lines here. Pending orders, when you recognize a bullish or bearish rectangle pattern, you can either A, enter it at market price once that breakout occurs, or B, set a pending order. The pending order you would want to set would be just above the resistance line for a bullish rectangle pattern or just below the support for a bearish rectangle pattern. In this example, you see a bullish rectangle pattern, okay? The second trend line is the resistance, right there, and the pending order will be set just above for a long. Okay, so right here we have our parallel lines. This is defining that width of that bullish rectangle pattern. It's bullish because we had a bullish trend. Okay, and you would set your pending order just above that resistance line. Okay, for a long position. Trail stopping and risk to reward. After you've decided whether you're going to be entering at market price or setting pending orders, you need to have that trading plan in place for your take profit levels. And you need to use solid risk management. In this example to the right, you see a bullish rectangle pattern, the same example as the last one. The second line represents your take profit level 1, and you would set multiple TP orders with a risk to reward of 1 to 1, 2 to 1, 3 to 1, and a fourth position of 3 to 1, but with a trail stop. Okay. Now in this scenario, it only hit your take profit 1. Okay, but if you were trail stopping this trade, or if you were, let's say it hit the 1 to 1, okay, you'd be moving that stop loss up, okay, to a break-even point at that part, or at that point for your 2 to 1, 3 to 1, and fourth position, okay. Now your fourth position is the only one you'd continue to trail stop up, but that's one thing I wanted to address to you guys. If you've watched the previous price action videos, okay, then you know that I do show the take profit levels. However, I did have a question from someone in the support area that asked about my 1 to 1, 2 to 1, and 3 to 1. Do I trail stop it? Well, the 1 to 1, no, I do not trail stop. It just hits that first take profit. It's out. Okay. Your 2 to 1 is set at a higher take profit. Okay. So once it hit that first take profit, you would move that stop loss to a break-even point. Okay. I don't trail stop that second one though. That's all I do is move that stop loss immediately, so that if it does go back against you, it's taking you out of the trade at, you know, positive a couple pips or just at a break even. Same with the 3 to 1. Okay, and then your fourth 3 to 1, you would also move. However, if it continues in profit, that fourth position is the one that you would continue to move. Okay, so you can continue to get the most profit out of it. Okay, so that's how I work my 4 positions. Okay. If 4 positions is too much for you, that's absolutely fine. Just stick with like a 1 to 1 and 2 to 1. All of these patterns that I'm teaching you guys in this price action series, I talk about having these 4 positions. Okay. However, all of the ones that I'm sharing with you guys, all of these patterns that I'm, you know, talking in depth about, they produce over 70% win rate. Most produce close to 80, between 75 and 80. Okay, so if you're using, let's just say you only do the 1 to 1. If you're using the 1 to 1, you would be remaining in profit. If you're using a 1 to 1 and 2 to 1, that's even better. Okay, maybe you can only handle, you know, 2 positions at a time per trade. Okay, and that's absolutely fine. Find what works best for you. I just like this because it works the best for me. Okay, I like to have those 4 positions. But I trade according to my account size. I always trade according to my account size. If you normally take 1 trade, okay, let's just say, for example, for a trade that sets up, if I'm taking 1 position, let's say I normally trade at $8 a pip, okay? Each of these positions, I do not trade at $8 a pip, okay? It's for each trade, I trade $8 per pip. So, these are positions of the trade. If you're trading 4 of these, you're trading at $2 a pip, okay? So keep that in mind. You got to use that good risk management, okay, along with a good risk to reward. But definitely keep that in mind. Just wanted to address that since I did have a question on it from someone in the room. In my next lesson, I'm going to be covering head and shoulders and inverted head and shoulders patterns. Okay? So you guys have a great one, and I will talk to you later.